If your goal is consistency and not excitement, then listen. Everybody tries to get those 10, 100x returns with meme coins. Many people got burned. The people that are surviving right now are the DCAs, the dollar cost averagers, the people that bought solid assets and buy into them regularly, potentially every week or every month. Now, there are many forms of dollar cost averaging. We can simply just save for the down payment of a house, or we can contribute to a 401k, right, to a stock retirement account, or we can do this for Bitcoin. For Bitcoin, it's less common. It's more common for stocks, but it's still a valid approach, because with dollar cost averaging, what we actually do is we do not just diversify across asset classes, we diversify across time. Because especially for volatile assets, not buying everything at the potential peak when attention is the highest, when most people are interested in the asset, but rather simply just spreading this out over time, can be a pretty good risk mitigation strategy. Now, the approach of buying regularly and consistently into an asset only works for assets where we have a long-term conviction in, where we do not care if the price goes down. Because usually the price goes down for something where then the market potentially is very spooked, where the market thinks everything will go to zero, right? The Bitcoin crashes 60, 70, 80% when nobody believes in it anymore. Properties crash when there's a big crisis and everybody is over-levered. Bank stocks crash when there is a global financial crisis. So really, we want to dollar cost average into something where we can potentially withstand the panic. We've got strong enough of a conviction to still want to buy that asset when everybody else tells us not to touch it. That's the real reason why dollar cost averaging outperforms long term. It might not necessarily outperform versus a bulk investment when we are already very depressed, but it very often is a nice risk mitigation strategy. Risk adjusted, we tend to do better than the average investor, because the average investor tends to buy when everybody talks about an asset. Many people are now considering, should I buy gold? Should I buy silver? But that's after the rally, and that's where potentially the risk is much higher. So in other words, there's a very small universe of assets where we can do this. We can't do this for most individual stocks. We can't do this for pretty much any altcoin. We can't do this for things that are speculative, where we change our mind very quickly. We have to do this for things where we've got very long-term conviction, where we want to hold this for 10 or 20 years. One heuristic might be, let's say you get arrested today for whatever reason, justifiably or unjustifiably. You get into prison for the next 10, 20 years. You can't do anything. If you've just got a few moments before you get into prison, how would you set up your wealth that once you get out, you will be well off, right? That's the whole idea. You can't really move much. And whatever assets you come up with that thought exercise might be potential assets to dollar cost average in. Because then you probably have strong enough of a conviction that in case things go down, you will still continue buying. And so then we have to ask ourselves, where does the conviction come from? Why would we continue to buy in case things drop? So let's say we buy the S&P 500, right? We buy an ETF like VOO. Why would we continue buying this during a crash? The common narrative is that we simply just bet on America. We bet on America continuing to stay the superpower of the world, continuing to dominate the world's economy. And so simply because of long-term America growth, we should get into something like VOO. So that's a strong fundamental conviction. Realistically, though, really, the S&P 500 is not going up because America is outperforming so well. It's mainly going up because of the US dollar devaluation. So when you look at how quickly is USM2 expanding, so how quickly is the money supply expanding, how quickly is credit expanding, you get at a rate of 6.8% per annum. That's also roughly how quickly the S&P 500 is growing over time. There are different numbers, of course. Some people say the S&P 500 grows by 8%, others say by 10%. So it might slightly outgrow 6.8%. But then you also have to consider potential fees that you might have on, say, an active fund, or potential taxes you might have to pay. And even if you don't have to pay any taxes today, you might consider the risk of potentially having to pay taxes in the future, in case that's then the political narrative of the day, right? When wealth concentration is too high, everybody says, tax the wealthy. Let's tax everybody that's got more than, say, $1 million US. And suddenly, the returns that look nice on paper might not be that much greater compared to just the 6.8% that the purchasing power is going down over time through the monetary debasement. But there's a case to be made that the monetary value will continue to go down, that the monetary base is going to expand, and so buying the dip in the S&P 500 might make sense. But as extension, many things then might make sense to buy. Many things that simply keep their purchasing power somewhat. Right? So that can also be property. That can also be gold. Now, the nice thing about property is that we can lever this up. And so if the monetary base is expanding, if the US dollar is going down over time in purchasing power, if we've got a lot of debt denominated in the US dollar, we are indirectly shorting the US dollar. We are betting on falling prices of the US dollar. If we take $1 million of debt, and then in a few years, that $1 million might only be worth $100,000 worth of debt, simply because the monetary base has 10x, simply because the US was printing money like crazy. Then we made profit from that, right? Our debt is suddenly worth less. We still have the house. We can pay off the remaining debt very easily because probably our income is also expanded. Maybe not by 10x, but at least by 3, 4, or 5x. Still, it's easier to repay the debt. We are betting on a falling US dollar by buying property with US dollar denominated debt. We can also do this with precious metals, right? We can do this with gold, for example. We can take a personal loan, and then instead of buying a car or some consumable with this, we can actually just buy a gold bar with this. Then wait for the gold to appreciate. Of course, right now, that's maybe not the smartest way to do things because gold has gone up that much. But in general, it's always a nice approach to look at things, right? If there is an asset class or particular asset that's currently very cheap, where we're willing to take on long-term bets, then we can also lever this up with some debt, because it seems like a pretty safe assumption that over the centuries, the US dollar is not going to gain purchasing power. Now let's talk about this dollar cost averaging approach again, right? Buying into an asset regularly does make a lot of sense, especially if the asset is currently not very hyped. Selling an asset, though, via dollar cost averaging out is not that easy. So you can buy for many, many years, every week or every month into something, but we can't necessarily efficiently sell something for many, many months efficiently in a way that we've got high enough prices. The issue is that prices tend to be relatively reasonable for the majority of times. And every now and then we get some momentum, some kind of rally that hypes up a particular asset. That can be crypto, right, where Bitcoin shoots up to new all-time highs. That can be tech stocks. It can be precious metals. There's always something where everybody has 100% attention on that thing, and that thing tends to appreciate very, very quickly. But we tend to be at those elevated prices only for a short period of time. And especially for the riskier assets, especially for things like tech stocks or crypto, they tend to then also crash down very quickly. So we've got normal, average, low prices for a long time. That's why you can dollar cost average in. But we don't have these elevated hype prices for a very long time. We might only have this for a few weeks or a few months. So we have to sell much more aggressively than we buy. We can buy, say, with $1,000 every month for several years. But once we sell, we can't do this for many, many months, many, many years. We have to do this for a short period of time. And so the amounts that we sell with are much, much higher compared to the amounts that we buy with. Because there's two levers here. The first lever is just the duration, right? Let's say 3 years versus just 3 months. So we've got a 12x higher leverage in terms of selling amount versus buying amount. But then also we are in a rally, right? So maybe the asset has doubled or tripled. So suddenly it's 12 times maybe 3, because we made a 3x, 36 times the amount. So we buy with $1,000 every month. We sell when we get out with $36,000. It's much harder to make decisions with $36,000 than it is for $1,000. And that's why most people are somewhat successful at buying low, but very few people are successful at taking enough profit when we are high. And it always seems like a very not sexy way to do things. As in, when Bitcoin is very, very high, everybody talks about it, everybody wants to buy more, and then you have to sell. And now the same is true for gold, right? Everybody talks about gold and silver, and everybody calls you crazy to sell into this rally. But that's probably the right thing to do, right? The minority of market participants win, the majority does not outperform. And so we have to do what the minority is doing. We have to do the contrarian thing. And the contrarian thing right now is not to buy gold, but to rather sell it. Now, why would we want to sell a well-performing asset anyways, right? It's all about having a diversified portfolio and owning everything at all times, right? We want to own some property, we want to own some precious metals, some crypto, some stocks. We want to own it all anyways. So why would we even want to sell anything at any point in time? I think the answer to this is risk allocation. As in, we have to ask ourselves, how much of our net worth do we actually want to have in a particular asset? So let's say we take crypto, right? Because crypto is relatively volatile. Let's say we bought relatively often into Bitcoin and we did this at low prices, say at around the 20, 30K mark. Right? So we bought regularly from 20 and 15 and 20 and 25K. We dollar cost averaged into Bitcoin, maybe an average price of 20K. Then Bitcoin goes on a run. And we can say this for any asset class. Some asset classes just get runs all the time. So let's say Bitcoin goes from 20K up to 100K. It made a 5x. With our dollar cost averaging at the beginning, we got maybe a net worth allocation of say 5%. Okay, so we bought regularly in small amount, 0.5% of our net worth for a while. We've got 5% of our net worth in Bitcoin. Now Bitcoin does a 5x. Suddenly, our allocation towards Bitcoin is closer to 25%. Now, do we want to have 25% of our net worth in an asset that has already rallied that much that can potentially again fall by 50, 60, 70%? I think the answer is no, right? If our initial comfortable allocation was 5% because we just want to have it as a diversifier, and suddenly a quarter of our net worth is in an asset that has increased in volatility, that has increased in valuation, we probably want to reduce our allocation, maybe back to 5%, maybe even below that, because now the prices tend to be much, much higher compared to where they used to be, right? So the market is much more heated. When the market is more heated, we obviously want to have less allocation, relatively speaking, compared to when the market is not heated. When the market is not heated and we've got 5% allocation, maybe when the market is heated, we only want to have 2 or 3% allocation. It still makes sense to own all the asset classes, but it also makes sense to rebalance allocations as we currently see particular market being hot or not. And if it's not hot, we want to just buy in. If it's very hot, we want to sell much more aggressively than we feel comfortable with. Most people don't sell aggressively enough because they're very happy with how much money they've made with this particular asset class. They might get very excited about it. They might put their identity towards it as well, right? I'm the Bitcoin guy. I'm the gold guy, right? They might love the asset. They might get an emotional connection to it. But really, that's when you want to exit. When everybody else gets super excited, you want to sell the majority of your allocation. This becomes even more important as net worth relative to income is going up. So it's not necessarily about the US dollar amount. It's all about your net worth relative to your regular cash flows. If your net worth is, say, 10 years of your income, then you have to be very careful, because if then, say, a quarter of your wealth is in something volatile, so let's take the Bitcoin example again, then you've got 2.5 years of your net worth in Bitcoin. If then this thing crashes, suddenly you've lost more than 1 year of your income just with that allocation. That's maybe not something that's very desirable. You'll take a long time of active cash flow accumulation, of active saving, just to make up for this drop. When your net worth, however, is much, much smaller, right? It's just a few months of your income, you can be much more risk on, because even if an asset class goes down, you're just waiting a few months and you will be back to normal again. So really, the higher net worth is relative to your income, the more diversified you have to be, and the more active you have to rebalance your portfolio allocations. And the more you should be willing to sell the thing that has rallied a lot. If you had 10% of your net worth in gold and gold has doubled, tripled, quadrupled, and suddenly a third or even more of your net worth is in gold, it's probably time to exit the majority of your stake. My brother, by the way, right? So this is a little private story here. My brother was very much a gold bug. He bought all kinds of precious metals because he believed that the fiat system is doomed. And he didn't really like crypto, it was too volatile for him. So he simply just saved in gold and silver. And he ended up with the current gold run to have more than 70% of his net worth in gold. He's also got quite a bit of capital. Just last week, before the big crash, he sold the majority of his gold stake after he has bought for such a long time. And it's not necessarily because he doesn't believe anymore in the collapse of the system. He simply just sees how the market is way too hype. If everybody talks about an asset, if everybody's wondering, should I buy as well? That's probably the time to exit, because at some point there won't be enough marginal buyers to give the same kind of percent increases. And then it's the OGs, the people that bought early, that simply dump on the market, that take profit. It's the same for pretty much any asset class. It's especially true for the very liquid asset classes. So with liquid asset classes, I mean asset classes that can be bought and sold very easily, right? Things like stocks or crypto or precious metals. And so whenever you're considering to potentially hold an asset for longer than what's reasonable regarding your target allocation, try to think about how you can balance this out, right? So let's say you're now very heavily in gold and gold has rallied a lot, but you still want to keep holding this for the current momentum and at least buy something that offsets this. At least buy something that's not correlated. And this might be as simple as just buying fixed deposits. Right, so just have something that has a little bit of protection versus the monetary debasement, but that's not going to go down in any way in case the market suddenly experiences a liquidity crunch and everything crashes. It's really about finding the right balance in a portfolio and thinking about the worst case. If things go down, if the inflated asset suddenly corrects, will you be okay with that correction? If the answer is yes, then simply just keep on holding. If the answer is no, because then your net worth relative to your income drops too much, then it's time to potentially sell parts of the position, maybe even the majority of the position, and reassess. If it's your first time here, feel free to subscribe. I've also created a playlist. Feel free to check that out. Just click on the channel here and then click on playlist. There's a playlist just for mindset and strategy videos like this. So feel free to just watch them end to end. Thanks again for being here on YouTube. Feel free to also check out the premium membership. Link to premium pops up here on the screen. See you next time. Cheers.